Hello, everyone, and thank you for joining. Today's webinar is Opportunity Zones 2.0, Navigating the New Tax Landscape. This session will explore the major updates to the Opportunity Zones introduced in the 2025 tax legislation, and we'll also clarify the new legislation effects on eligibility, timelines, and compliance requirements, and provide actionable strategies to help you position your Oz investments for long-term success. The session also qualifies for 1 hour of CPE, and you received earlier information on how to qualify for that CPE. My name is Mark Cooter, and I'm the partner and leader of our real estate, construction, and hospitality industry practice at Cherry Bekaert. I'm also pleased to introduce our other speakers for today, which is Andy Ackerman, partner with Cherry Bekaert, Catherine Baisley, partner with Cherry Bekaert, and Chris Kaufman, partner with Frost, Brown, and Todd. So let's get ready and just dive right in. So a little history on the opportunity zones. Opportunity zones today, we're going to go through the history. We're going to talk a little bit about what happens in 2026 with current legislation recognition. We're going to talk about new legislation, and then we're going to talk about new reporting requirements as well as takeaways and planning opportunities for both Opportunity Zone 1.0 and Opportunity Zone 2.0. So a little brief history. The original 1.0 was enacted with the Tax Cuts and Jobs Act in 2017. This was when opportunity zones were first introduced. Opportunity zones provided a tax incentive for taxpayers to reinvest realized capital gains, whether those were short-term or long-term, into certain property and businesses located in specific geographic areas, primarily in low-income census tract areas that the Treasury had designated as qualified zones. Opportunity Zone census tracts retained their designation for 10 years. And then there was also act by Congress to make sure that the qualifications and the benefits for those designated census tracts lasted for about 30 or 35 years after that. As a reminder, the main incentives for investing in an opportunity zone, there were three main incentives. The first was a temporary deferral of capital gain, which we'll talk about shortly. Originally, that was you could defer it until the year 2026. The next was a step up in basis. So there was a discount that was allowed on that capital gain you deferred, depending on the length of time you invested, which we'll also be getting into. And then ultimately, the largest benefit was a permanent exclusion of any gain on appreciation upon sale of that property. Those were the three main incentives that were attractive about opportunity zone investing. So our first polling question is, have you invested in an opportunity zone? We'll give a few minutes for that to load up and get answers, and then we'll move on.
And Mark, one person, just in case people don't see the chat, someone had asked if the slide deck will be available. We'll be using it during the presentation, but then we'll follow up in a week or so with the deck.
Yes.
And video of the report of the presentation.
And there will be links within the deck, live links within the deck for other materials.
Yes.
All right, Chris, I'll turn it over to you.
All right, thanks, Mark. So as Mark indicated, just want to dig in a little bit more into the current opportunity zone incentive under the Tax Cut and Jobs Act. I think just to make a designation for everyone so that we're not confusing our participants is we'll refer to, at least I will in my discussion. I don't want to make a rule for everyone else, but I'm going to refer to the Tax Cut and Jobs Act, the current standing version of the Opportunity Zone Incentive as version 1.0. And then as we talk about the changes that were enacted under the One Big Beautiful Bill Act, we'll refer to that as Opportunity Zone version 2.0. Just easy for me to make a distinction in my mind, at least, as we talk through this. So under version 1.0, you have a temporary gain deferral. Again, just as a reminder for those of you that may don't have much of an understanding or experience with opportunity zone structures or investments, the incentive is tied to qualifying capital gain investment, as Mark indicated. That capital gain investment has to be made in a qualified opportunity fund. And one of the incentives provided with that investment is to the extent you recognize or have a capital gain event, you elect to defer that gain by investing that gain into a qualified opportunity fund. You are able to have a temporary deferral, not a permanent deferral, but a temporary deferral of that initial gain investment through December 31, 2026. So as the incentive was enacted in 2017 with the Tax Cut and Jobs Act, initially in 2018, a 2026 deferral sounded like a long way off. Currently, it doesn't sound like that far off at all. We're nearing that date. Additionally, there was a basis boost or basis step up, as Mark indicated. If you made your investment, your qualifying investment into a qualified opportunity fund by December 31st, 2019, and held that investment for 7 years through the end of the temporary gain deferral period, December 31, 2026, that 7-year hold period, you got a 10% basis step up to be held for 5 years, and a additional 5% if you held for 7 years, for a total of a 15% basis step up with respect to your investment. So I know confused a little bit there, but the essentially what that means is if you had $1 million of deferred gain, you invested it and held for 7 years. You made that investment prior to December 31st, 2019. Instead of recognizing $1 million at the end of your gain deferral period, you would recognize $850,000. You have a $150,000 basis boost. But again, because those incentives were tied to particular investment dates, those incentives have since timed out. So even though we still have Opportunity Zone version 1.0, you're still eligible to make investments under the version 1.0 incentive. You no longer are entitled to the 10% basis boost or the additional 5% basis boost. And your temporary gain deferral period is much shorter than it would have been if you had made your investment several years ago. And additionally, the recognizing that once the deferral period ends, you would have tax due and owing on that, again, on that initial deferred gain in 2027. We can move on to the next slide. So how did that change under the One Big Beautiful Bill Act and coming into version 2.0? As many of you are aware, we had the One Big Beautiful Bill Act that was signed into law by the president July 4th, 2025. Comprehensive tax reform, a lot of different changes. The one in particular we are focusing on here was the permanent extension of the Opportunity Zone incentive program. The version 1.0, the way it was enacted under the Tax Cut and Jobs Act, would eventually time out. The temporary deferral period and the qualifying gain had to all temporary deferral period ended by December 31st, 2026. Qualifying gain had to be incurred prior to December 31st, 2026 in order to be eligible for investment. So ultimately, as enacted, version 1.0 was going to time out and conclude and sunset. But what the One Big Beautiful Bill Act did was made that a perpetual extension of the program beyond that 2026 sunset, and has some additional modifications and enhancements to the incentives that we'll talk about today. We can go to the next slide. So under the old rules, as we talked about, you had a deferral and basis boost that were tied to specific dates. And so, to the extent that you were able to get in before the December 31st, 2019 deadline, or the December 31st, 2021 deadline with respect to the basis boost, and to the extent that we had the ultimate temporary deferral deadline of December 31st, 2026, depending on when you invested, the value of those incentives changed. And so it was really kind of not necessarily a disincentive, but depending on when you invested, you were entitled to different incentives. What the new version 2.0 does is creates essentially incentives that are tied to your investment date rather than making sure that all investments are made before a certain date. So essentially all of the investors under version 2.0 and going in perpetuity will be entitled to essentially the same benefits regardless of when they invest in a qualified opportunity fund. Under version 2.0, rather than having a deferral period that ended at a set date of December 31st, 2026, you now have a rolling 5-year deferral date from your investment date in the qualified opportunity fund. Again, you recognize qualifying capital gain, you elect to defer that gain by investing it in a qualified opportunity fund. You can now defer that gain temporarily for a period of 5 years from the date you invest in the qualified opportunity fund. Again, there's not a set date that applies to all taxpayers. It's dependent upon when the taxpayer elects to defer that gain by investing in a qualified opportunity fund. Additionally, the basis boost, the basis step up that we discussed under version 1.0, that basis boost again, was tied to a specific date. You had to invest before that date and hold for a certain period of time before the end of the deferral period. Now, that basis boost, as long as you hold your investment in a qualified opportunity fund through the 5-year deferral period, you will get a 10% basis boost at the end of that 5-year deferral period. So again, you're not restricted by when you invest, depending on when you invest. As long as you hold that investment through the 5-year deferral period, you will also, in addition to the temporary deferral, get a 10% basis boost at the end of the deferral period. And these new incentives under version 2.0 will apply to investments, qualifying investments in qualified opportunity funds made January 1, 2027 and into the future. So any investment in a qualified opportunity fund made on 12/31/2026 or prior will still be governed under the old version 1.0 incentive. Investments made in a qualified opportunity fund January 1, 2027 and beyond will fall under the new incentives with the version 2.0. So you can still make an investment now in 2025. You can still make an investment in 2026. You would just be under the version 1.0. You would receive the incentives under the version 1.0. So you would have a temporary deferral through December 31, 2026. You would have no basis boost, but you would still get the exclusion on appreciation as long as you hold your investment in the fund for at least 10 years. And again, that exclusion on appreciation, that benefit is also available to you under version 2.0. So there is some timing consideration here. We'll talk about this more from a planning perspective later on in the program, but you generate gain in 2026, you potentially could invest in 2027, depending on the timing of that gain. You know, the typical rule is that you have a capital gain event, you have 180 days from that capital gain event to invest the gain within the qualified opportunity fund. That timing changes depending on how the gain is generated. If it's generated through a pass-through entity, then there are potential other dates in which you could potentially timely invest in the qualified opportunity fund. But again, you could have a situation potentially where you've generated gain in 2026 and you could choose to invest in a under the version 1.0 incentive or invest in 2027, assuming you can still make a timely investment in 2027 and get the version 2.0 incentive. And so there at the bottom of the slide, you know, it's just a simple example. This is under version 2.0. Taxpayer generates a qualifying gain. Say they sell Apple stock or some other type of stock. It generates a gain of $1 million. They elect to defer that gain by investing in a qualified opportunity fund after January 1, 2027. As long as they hold that investment for at least 5 years, They would get a temporary deferral of that gain through the 5-year hold period. And then at the end of that 5-year period, they would also get a 10% basis boost so that when the deferral period ends, rather than recognizing the $1 million of deferred gain, they only have to recognize 900,000 of the deferred gain. So it's a 10% reduction on the gain that's recognized at the end of the deferral period. We can,
Chris, while we're talking about the timeline and questions come up, do you have to create and form a new qualified opportunity fund for new qualified opportunity zone business investments made starting in 2027, or can this be done through the same QOF funded in 2027 or later? I assume that means 2017 or later. But basically, can they use the same QOF that they used before for new investments under the new rules? I would answer that they need a different QOF.
yeah,
New QOF, because the QOF, the Qualified Opportunity Fund, its time period has started again with this new investment using the old one. The old one has old rules. You'll need to start a new one that has the new time period associated with it. So you would need to start a new Qualified Opportunity Fund for the new opportunities in business that you started post January 1st, 2027.
yeah, I would agree. I mean, I think for a variety of reasons, I think the best approach would be to have a new qualified opportunity fund to address your version 2.0 investment. All right, we can move on to the next slide, which I believe is a question. Yeah, so here's our polling question 2. Do you anticipate investing once Opportunity Zone version 2.0 begins?
Hey, Chris.
Yes.
I think it's one thing it's kind of important to point out because I have seen this come up in practice over, ever since this was introduced for 1.0 and then in 2.0 again. The first step with this is you have to have a capital gain. I've had people come to me that said that I'm invested in a qualified opportunity zone. I should be entitled to the benefits at the end of the 10-year hold. And, one of the questions that had come out in the discussions is they never had that capital gain, that initial capital gain, and making sure that that's step one before you can even begin to participate in this is that box has to be checked first.
I wholeheartedly agree, Andy. I mean, and I think another thing to add with that is sometimes we deal with clients, taxpayers who have property in a qualified opportunity zone census tract. And they think because they have that property in the census tract, they're entitled to the incentive. And that's not the case either. I want to make it clear, although we're not, going back and rehashing kind of a lot of the basic principles of opportunity zone structure, having property in a opportunity zone census tract is not does not mean you're entitled to the incentive. The incentive is tied to and meant to encourage private investment in qualifying property, qualifying businesses located or utilized in a trade or business within an opportunity zone, designated opportunity zone census tract. And so the incentive is tied to that investment. That investment has to be made into a qualified opportunity fund and then invested into qualified opportunity zone property or qualified opportunity zone business. And then that business or that property has to meet certain requirements under the Internal Revenue Code as well. But there has to be that investment. That investment has to be generated through a qualifying capital gain. I know I saw a quick chat question whether it could be are short-term, long-term gains treated the same. Yes, from a qualifying investment standpoint, they are. It just has to be capital gain for federal tax purposes. To the extent you invest short-term gain, it retains its nature through the deferral period. So, if you invest $1 million of short-term capital gain and you defer that gain for 5 years through the temporary deferral period, when you ultimately recognize that gain, it's still short-term gain. It's not treated differently simply because you've held your investment in the qualified opportunity fund for 5 years. And the same with long-term gain, that you defer long-term gain when the temporary deferral period ultimately ends, it's still long-term gain. It retains its character through the deferral period.
Chris, one thing I would like to add to this conversation is, we're talking about from the investor side that if you invest in a fund, it does need to be a capital gain, a qualifying investment in order to reap the benefits of everything we're talking about today. But at the fund level, they can admit investors that aren't looking for the OZ benefit. If there's a deal that sounds great, they can certainly take money from anywhere. Those people just won't benefit from the OZ pieces that we're talking about today. And I've seen that a lot in practice when people are looking for ways to strengthen the capital stack and not lean solely on OZ qualifying investment funds.
Yeah, that's exactly right. The opportunity zone capital is just another piece to fulfilling the necessary capital stack for a particular project. You could have non-qualifying gain invested into a qualified opportunity fund. Like you said, they just wouldn't get the benefit. You could have other capital, non-OZ capital coming into the QOZB, the underlying project entity that doesn't have to come through a fund. And again, it just would not receive the OZ benefit as well. We're talking specifically what's necessary to get the opportunity zone incentive, and that's tied to specific qualifying gain invested through a qualified opportunity fund. But yeah, that doesn't negate the ability to bring in other capital to a particular project. That capital just doesn't get the benefit of the incentive.
One other thing that I've seen in practice that just has come to mind is, most people are thinking, pretty simplistically, there's the fund and then there's the qualifying business that the fund is investing in. The investment and the business is not limited to one fund. You could have 2 or 3 qualifying funds that are all investing in the same project. That is not unusual. So some people think they're precluded from, maybe they aren't interested in this particular fund because of some fees or what have you, but they're interested in the project. Another fund can come into the project.
Additionally, so there are the enhanced incentives that come under the changes created by the One Big Beautiful Bill Act. One of those will be the rural designation, the enhancement that come with the rural designation that I know Andy will talk about here in a little bit. But also under the version 1.0 that was enacted with the Tax Cut and Jobs Act in 2017, there was a process through which the opportunity zone census tracts were designated by Treasury. And so the way that process worked under statute was that each state and territory was given the opportunity to nominate up to 25% of their qualifying census tracts for designation by Treasury as opportunity zone census tracts. And qualifying census tracts were tied to income restrictions. Again, this project was enacted by Congress as a way to incentivize and encourage private investment in areas that had historically been neglected from an investment and capital standpoint. So focusing on low-income census tracts as determined based on criteria under the Internal Revenue Code and designated by Treasury. The version 1.0 essentially had a qualifying threshold that was 80% of the average mean income for the census tract. If it was in a rural, if it was outside of the metropolitan area, the average median income within the state. If it was within a metropolitan area, it was 80% of the average median income within that metropolitan area. But there was that threshold. Again, the incentive was designed to benefit those low-income communities, and the version 2.0 has tightened that threshold to 70% AMI. There's some additional potential other ways to qualify based on the poverty rate within that census tract, but what essentially was a general 80% AMI threshold has been tightened to 70%. And And so, we've got a smaller world of opportunity zone census tracts that we're dealing with in version 2.0. The initial census tracts that were designated as part of 1.0 lose their designations as of December 31st, 2028. And so the legislation created a new rolling decennial designation of new census tracts. So every 10 years, recognizing that version 1.0 tracts are going to expire December 31, 2028, every 10 years now, there is a process under the Internal Revenue Code by which states will begin to nominate census tracts for consideration by Treasury, and then Treasury will ultimately designate those census tracts as opportunity zone census tracts. They'll keep that designation for a period of 10 years. And then as those tracts are beginning to near expiration, the process starts again. And we have the potential for new tracts to be designated, existing tracts to be redesignated. That's a process now that will keep this incentive going on in perpetuity because we now have a process in place to have existing census tracts designated by Treasury. It's interesting looking at how that income threshold will impact the kind of the world of opportunity zone census tracts. We currently have about 8,700, 8,800 designated tracts in the United States and its territories. It's anticipated with the tightening of the low income threshold to 70%, that will be reduced somewhere below 7,000 total tracts. So we'll have a reduction of about 1,800 total tracts. If you look across each state based on kind of the data and trying to anticipate how many tracts each state will have from an eligibility threshold, it's about a 10% to 25% decrease in the number of tracts that each state is expected to have. So there is going to be a little more, I think, competition between certain tracts as to whether they will receive a designation as opposed to other tracts within a state. The limitation being that each state can only nominate up to 25% of their total qualifying low-income census tracts. So there is a cap on the number of tracts that each state can nominate, and then Treasury just reviews to ensure that those nominated tracts meet the criteria, and then they designate and approve. So the census tracts are what they currently are for version 1.0. Again, those designations will expire December 31, 2028. The new version 2.0 census tract nomination process begins July 1st of 2026. That's when each state can begin, and it's the executive branch of each state. So each state's governor will nominate census tracts, qualifying tracts within the state. They have 90 days to do that beginning July 1st of 2026. They can request an additional 30 days if they need to. And then once Treasury receives those nominations, Treasury has 60 days then to designate those tracts as opportunity zone census tracts. So the plan being by the end of 2026, we'll know the universe of opportunity zone version 2.0 census tracts, and then they will become effective as of January 1, 2027. So there is going to be a overlap of opportunity zone version 1.0 census tracts that expire December 31, 2028, and opportunity zone version 2.0 census tracts that become effective January 1, 2027. You're going to have a 2-year period where it's presumed that we'll have 2 sets of eligible tracts that qualified opportunity funds can invest in and make qualifying investments in. That's the presumption. I think it's a safe presumption. But we're also going to be dependent on additional guidance from Treasury to confirm that. So, there's going to be this transition period where hopefully sometime soon we'll get some guidance from Treasury as to whether version 2.0 investments can be made in version 1.0 census tracts. And so hopefully we'll get that soon.
All right, so now we're going to talk about another one of the new concepts in OZ 2.0. It's this concept of rural area invested. So they've created a new class now of rural opportunity zone funds that are they're similar in the fact that to the existing opportunity zone funds, that at least 90% of their assets must be held in qualifying property or equity in an opportunity zone in a qualifying census tract. They've added a new definition for what rural is. Rural is essentially effectively it's any town or city that has a population of 50,000 people or less, and it can't be adjacent or contiguous to a town that has more than that. The other piece of this as well, if you invest in one of these rural opportunity zone funds, similar to what you have the 5-year deferral period, at the end of that 5-year deferral period, instead of a 10% step up that you're now entitled to, there'll be a 30% step up, 30% basis boost. So going along with the concept that we've talked about, a sale of $1 million in stock, instead of at the end of that 5-year period, now the investor is going to owe tax on $700,000 instead of $900,000. So it's an additional basis boost to really help drive investments into these rural opportunity funds. One other thing that they also did with this as well is they lowered the threshold for the substantial improvement. Under the existing rules, if you buy a piece of property in an opportunity zone, in a qualified opportunity zone business, you have to substantially improve that property 100%. So you buy a building for $500,000, you have to put another $500,000 into that building, additional, rehab, construction, what have you, into that building to qualify. Under the rural opportunity zone funds, that substantial improvement drops to 50%. So now, same $500,000 purchase of a building. Now you only have to put in 50%, $250,000 to qualify for that. As you know, the one big thing we're waiting on here is guidance, and we did get some guidance drop back on September 30th, notice 2025, that formally identified 3,309 qualifying rural zones that would qualify for these type of investments. And it also formalized the substantial improvement test to 50% versus, the normal 100%.
And Andy, one thing I just wanted to point out with respect to that notice, the rural OZs that they identified in notice 2025-50 are the existing version 1.0 opportunity zone census tracts that qualify as rural zones. And the legislation and the notice make it clear that the effective date of that substantial improvement test for rural zones is effective as of July 4th, 2025. So although the version 2.0 benefits that we talked about don't apply until investments made in qualified opportunity funds in January 1, 2027, the rural substantial improvement threshold is already effective for those existing OZ tracts identified in notice 2025-50.
Great. All right. So I think we're on to our third polling question. Are you interested in learning more about the additional benefits of the OZ in rural areas? I think this is something that's a lot of interest that I've heard about this. And, certainly what Chris said a second ago with those zones being available now, it has really increased a lot of, inquiry and, how is this potentially going to work? What are the basis step ups on this? So started to get several questions about that.
While we're waiting on that polling question, we did have a question. If we are qualified using a current qualifying track and that track becomes no longer qualified in, I assume this to be 2027, do we have to move our business to stay qualified, or are we grandfathered in? And I believe, Chris, you answered that you are grandfathered in, and there'll be two simultaneous different tracks going on.
Yeah, so the existing tracks are effective through December 31, 2028. It's my opinion, given the fact that under version 1.0, you could hold your investment until December 31, 2047, before you had to sell to recognize the OZ incentive. That yes, you would be permitted to continue to operate and qualify as long as you met the requirements prior to the expiration of the zone. But again, that's something I think we're going to need an affirmative answer and guidance from Treasury. But that's the assumption, just given, you under the existing law, you had until 2047 to sale, and in 2028 is when the OZ, expired from an investment standpoint. So
Yeah. So the answer is you are grandfathered in under the old rules. You do not have to move your business. Your qualified zone still exists. All right, moving on.
All right, let's talk about one of the other changes that happened. Again, under Opportunity Zone 1.0, the appreciation happens. You have to hold it for a minimum of 10 years. But if this is a great project, if you want to take advantage of the appreciation exclusion, you did under the current OZ rules under 1.0, you did have to sell that investment on or before December 31st, 2047, to be able to make sure that you got to exclude all of the appreciation. Under the new 2.0, with investments made after January 1st, you're still going to have the same 10-year hold. However, at the end of the 30-year anniversary, you have the ability, if this is a great project and it's not something that you want to hang on to at the end of 30 years, you're going to have the ability to elect to step up the basis at that point. And then if you hold it beyond that 30-year period, any additional appreciation that happens after that 30-year anniversary would also be subject to tax when that investment is sold. Now, I don't know about you all, but holding any kind of investment after 30 years, that's a long time down the road, but that is something that they did add into these rules. Next slide. So one of the other things that they did put into this, there are additional reporting requirements, and there's been a lot of calls over the years to for increased reporting, and in an effort to create transparency for the Opportunity Zone businesses, the Opportunity Zone funds, they're going to require additional reporting that's going to take place. This transparency is going to be in terms of type and locations of where these investments are held. And this additional information, the government is going to collect this to provide, some economic impact data and how these funds and how these businesses are, changing the areas in which they're occurring in. The kind of the got the carrot with this on the appreciation, but the stick on it is, there are going to be significant penalties imposed for noncompliance. And these penalties can range anywhere from $10,000 up to $50,000, depending on the size of the QOFs assets. Next slide. So a lot of, as existing QOFs right now, they do have reporting requirements that has to be done on an annual basis. There's a Form 8996 that has to be included on every qualified opportunity fund. We're, in addition to how that is going to be going forward, there's going to be some mandatory annual reporting that is going to include maybe asset composition, the timing of investment, when did those gains get deferred into there, compliance with the 90% test, and then the location and nature of the qualified opportunity zone property. If you've got multifamily, they're going to be looking for the number of potential residential units that are included in there. The penalties, as I mentioned, for non-compliance, up to $10,000 per missed return, and then up to $50,000 for qualifying funds with assets of greater than $10 million. And again, the big thing on this is, how this is going to be reported at this point. We're still waiting on guidance. But as part of this one big beautiful bill, they did allocate up to $15 million to the IRS for enforcement and implementation for this. So there's going to be a big push to make sure that this is tracked and reported. Next slide. There's also going to be some reporting requirements for QOZBs, and the type of tangible property that's used in the business, and then employee locations and payroll data, and then again maybe the potential number of residential units. These reporting requirements, they're going to be effective for tax years after July 4th, 2025. So again, we're going to be waiting on that guidance to kind of indicate how that has to do. But the main thing is it's going to create additional transparency for all these funds. I think we've got polling question number 4. Do you anticipate needing assistance with OZ structuring, testing, or compliance?
Andy, while we're waiting on that, 2 additional quick questions. One question, I believe the old QOZB rules had an exclusion related to triple net leases. What about new qualified opportunity zone business rules? That is still in place. It needs to be a trade or business, and triple net lease would not qualify as a trade or business.
I would agree with that.
And the second question is, maybe I missed this, but is it correct that qualified OZ 2.0, there's only one step up basis of 10%, no additional 5% basis? That is correct. It's 10% or 30%. It could be 30% if you're rural per the rules Andy went over, or 10% if it's non-rural, but there is no 15%.
One thing that I think we should add related to this polling question is I think people haven't necessarily taken some of the compliance and the reporting very seriously. I know, people get really excited and like to move forward and kind of charge forth with the investments, but it is going to be more critical than ever that things are documented well. I mean, a lot of times I'm receiving information from the underlying qualified opportunity zone business that doesn't have the related disclosures that we need to properly report at the fund level. And this is just an area where, in my opinion, people should not cut corners or cut costs. Just do it correctly the first time.
No, Kat, you're exactly right. And I know as part of all the funds that we prepare, and then the QOZBs, we've got all these required disclosures that we put into the K1 footnotes to help individual preparers or whoever's working on those returns, because they need that information to be able to report accurately. And I think it's going to become even more important going forward. So I think a lot of those questions, and it'd be interesting to see how they update this, whether the 8996 becomes a lot more complicated, which I think is probably what's going to happen, or if there's going to be additional forms that are going to come out as part of that as well, new boxes on the K1s or anything like that.
I think it will be all of the above.
I think you're exactly right.
So, Kat, let's jump into the fun stuff.
Okay. So what we want to talk, we've kind of given you an overview of the history in version 1.0 and what's happening in version 2.0. So a couple big things on the horizon. We've talked about the 2026 gain recognition event. As we've said, the gain that was deferred, the qualifying gain that was deferred previously must be recognized by 12/31/2026. Which means the tax will be due in April of 2027. Now, most people are thinking, okay, I deferred $1 million. I might owe tax on $1 million. Maybe I got the benefit of some step ups. Maybe I only owe tax on 900,000, or 850,000. But there actually is some good news. If for some reason the IRS is allowing taxpayers to recognize their gain on the lesser of the original deferred gain or the fair market value of their investment in the fund. And, that is that's critical for some of these funds that had some early struggles, especially when COVID hit, interest rates, tariffs, some of the challenges they faced in the construction sector. But in order to recognize the gain at the fair market value of the investment, a valuation will be critical. We are strongly encouraging people to have those conversations now and to work with their fund managers to get a valuation on what that investment is valued at now. And why this is especially important is because many of the funds, let's say you did invest $1 million, maybe you didn't put any extra cash away to pay your tax that will be due in April. Maybe you thought your investment would already be spitting off some cash that would be available for you. That may not happen. So people will have this, what we call a phantom income event, where you have a taxable income recognition, but no cash related to that event. So it is critical to start planning and having those conversations now. And as you'll see on the side of I don't know if it's your right side or hopefully it's your right side, but we've laid out a timeline of when you should start thinking about these things. In practice, I've already started talking to some clients, especially those with funds that haven't yet lived up to the expected performance, but about how important this valuation is and the related communications to their investors. In second quarter of 2026, that will be the time to execute the preliminary valuations on these funds. Fourth quarter and into first quarter of 27, you'll want the valuations finalized so that people have that as documentation for when the tax is going to be due on April 15th. And I'm sure looking at this timeline, it seems, that we may be getting a little bit ahead of ourselves, but there are a limited number of qualifying professionals that can do these valuations, and we need to make sure we give them sufficient time to get this done. This is not something that you can come in, April 1st of 2027 and say, oh, yeah, let me get this valuation. It is critical to be having these conversations now. And my recommendation to my clients that are the individual investors is, if your fund hasn't reached out, hasn't spoken to you about it, reach out to the fund. Be proactive, represent yourself and say, hey, here's something that we should be thinking about. And when you get the slide deck, there will actually be a link to an article that we've written that outlines a little in more detail, kind of the benefits and the why and the how. But this is something that we think everybody should be considering. And some additional planning steps the valuation is a great tool if the value of your investment has decreased, but maybe it hasn't decreased. Hopefully it hasn't decreased and your investment is just fantastic. So what can you do if the fair market value has increased? What are some options and some things that you can take advantage of, knowing you're going to have that tax hit in 2026? I mean, one thing, you're going to have a gain. Maybe you should start harvesting some losses, across your portfolio to offset that gain. Maybe you should take advantage of other losses, maybe not just in your portfolio accounts, but are there other losses, whether they've been suspended in the past or they're carry forwards that should be taken into consideration? Cost segregation for those projects. Oh, Andy, did you want to say something?
Yeah, I was going to say the cost seg, that is one way that we have worked with some of our funds to really maximize some of the return back and help offset some of those income that they're going to have in trying to plan when those cost segs are going to happen. And again, you're talking about, it has to be the right type of loss coming from the cost seg to offset the potential capital gain. So the planning has to be done there. But one of the things with the cost seg, really increase the amount of depreciation deduction that is flowing through to the project, especially with a lot of the real estate. I mean, I do a tremendous amount of real estate, and those cost segs are really crucial in driving as much deductions as possible. And then, there's no depreciation recapture at the end of this. So that's the flip side of this is as much expense deduction as you can get into these projects, you won't have to recapture that on the back end.
Exactly. And for those of you that aren't familiar with depreciation recapture, typically if you're getting the benefit of depreciation, the IRS is saying, well, wait a minute, you're already getting the benefit at ordinary rates of this great deduction. So when you go to sell, you have to basically pay some of that back. And it's typically taxed at about 25%. Well, what Andy's talking about is, let's say I've had the benefit of $100,000 of depreciation expense that's flown out to offset other income on my return. When we exit the deal after the 10-year mark, I don't have any of that that's going to be picked up and taxed at 25% or whatever rate might be in existence at that time. Has anybody else had any discussions with clients now, or looking at anything that might be of interest to this group?
Yeah, I was going to say, certainly we're looking at clients as we go into the end of 2025, what kind of loss carry forwards they might have that's going to help offset that if they've generated prior losses. As you already mentioned, the harvesting capital losses, things that are going to offset that type of capital gain, and just other ordinary deductions through operations like cost seg. Yes, looking at all those to sort of help mitigate a current tax event like that to cover that phantom income.
Yep. Oh, I just realized the time. We have 5 minutes left, so I might step on it a little bit. Opportunity Zone version 2.0 for new investment opportunities. It's really been an exciting time as it relates to Opportunity Zones. We are getting a ton of questions about it, a lot of interest from people that weren't historically invested in version 1.0. They kind of shied away from it, but it's for a variety of reasons. One of the biggest reasons that I have seen is at the fund level, the ability to bring in capital over a period of time. In version 2.0, if somebody invests in 2027, they recognize that they pick up that gain, that deferred gain 5 years from that point. If they invest in 2028, they're not picking up that gain in 2032. They're picking it up 5 years from when they make that investment. So that gives the funds a lot of flexibility to draw investors in at different points in time. Another thing that we will talk about is just the fund, the transitions and the safe harbor for existing funds and for exiting. We want to make sure that the exits are done appropriately, but it's also generated interest in that with some of the folks that I work with in the real estate area that typically like to develop and hold. They didn't want to be forced to sell an asset after 10 years under version 1.0. So under the new version, the fact that they can hold it for 30 years and then freeze the value at that point has been something that's very interesting to them. The rural strategy, we touched on this a little bit. Chris touched on this a little bit earlier, but you want to separate your urban and rural investments. Chris, did you want to explain a little bit about why that is so important?
Sure, happy to, Kat. I mean, as Andy mentioned, the rural opportunity zone benefits are tied to investments in rural opportunity funds. It's a separate classification of opportunity fund that was created under the new legislation. And to qualify as a rural opportunity fund entitled to those incentives, you have to meet certain investment thresholds in qualifying rural property. So, to the extent that you were to kind of twin investments in a rural project and an urban project, you would potentially, create a situation where you could lose those enhanced benefits for the rural project. And so I think, to the extent that you're investing in rural projects, you want to do that through a rural fund. You're investing in projects in metropolitan areas, you're doing that through a traditional qualified opportunity fund.
Yep. Okay, I'm just going to keep moving along. This is a side-by-side comparison of where it says 2017 TCJA, that's our OZ 1.0. 2025 tax return is version 2.0. And this is just a quick reference chart to see the differences between the two. It will be in the deck that we are sending you, but this is something that, for people that learn visually, I think is incredibly handy. And I'm just going to rush us right through to our last polling question. Have you considered evaluation to determine the fair market value of your existing OZ investment in an effort to reduce the tax due on the deferred gain? And hopefully you guys are paying attention and you're all going to say either yes, or you would like to learn more, or your investment is doing incredibly well. But
Pat, while we're waiting on that, I did have an earlier question just to confirm if that was not picked up on earlier. If you have a capital gain in Q4 2026, can you wait to invest in a QOF in 2027 to use the new rules? The answer to that is absolutely.
yep.
You need to pay attention to the timing. It's once again critical about the 180 days. Where did that gain get generated? Was it from stocks or securities, or was it from a partnership interest? All those play into that account. But certainly in Q4, you should be able to manage that quite easily and get into a 2.0 QOF.
And that person really has the best of both worlds because they can make the decision of which 1.0 to go into or 2.0, and they have the option of both sets of designated zones.
Yep.
So Mark, I will
Timing
kick
is
it over to
critical.
you.
Yep. Next slide, and so just as we wrap up, just want to point out these will be live links when we send out this presentation. But if you go out to cbh.com, you can go into insights. These are just an example of some of the recent opportunity zone articles that we published to our website that are available for you to look at, and so you can sort of see what's been done in the past about strategies and about comparing to 1031 exchanges and other important information about 2.0. So I want to thank everybody for their participation as we've come up on an hour. We appreciate it. If any questions, we've included the contacts in this presentation, and we look forward to hosting you again in the future. Thank you very much.